G'day and welcome to the Off-Chain Podcast. Our guest today is David Post, founder of Helix and co-founder of W3.io. David previously led ventures and ecosystem strategy for Chainlink Labs and founded IBM's blockchain ventures. A true venture builder, we're excited to talk to him about his experiences in accelerating and scaling early stage startups and something huge he's working on for the Web3 ecosystem. Let's dive in. Dave, tell us, how did you get started in Web3? What's your origin story there?
So I was at IBM working in the blockchain unit for a long time, and I remember it was pretty interesting. I was kind of like crypto adjacent, but very focused on kind of like enterprise blockchain networks. So I remember going to like the early multi-coin summits in like 2018 and 2019, and like meeting the founder of Scale and us talking and him being like, "I have no clue what you do," and me being like, "I have no clue what you do." Or I was sitting in the audience next to someone who invested in Arweave and be like, "Did you actually invest in this thing?" So I was kind of like very much on the enterprise side of things as opposed to the permissionless side of things. And I ran IBM blockchain ventures for a number of years. So just kind of like the enterprise network incubation arm of the blockchain unit. One of my favorite topics is off-chain compute. So we'll come back to that. But basically it was DeFi summer in 2020. And I was watching what was going on. And I was like, wow, there's something qualitatively different happening here. There's actually real use cases being built. And if there's one, there's probably two, there's probably three, there's probably thousands. So started trying to get into the crypto space, got offered a job with one protocol, they took the offer away. So I was like in December of 2020, like, what should I do? And I came across this the Chainlink, and I was like, wow, this is kind of interesting. This company looks like it has the basis and the capabilities to kind of become the go-to protocol for everything off-chain and everything on-chain. So the story is actually, quite basic. I messaged the head of HR on LinkedIn, and I started interviewing. And I started in Chainlink in the first quarter of 2021. But I'm not somebody who was buying Bitcoin in 2014. I can't say I had a very high level of conviction in what was going on here until probably I started really working in the industry.
Yeah, gotcha. Well, so what did that look like then, being involved in blockchain, but at IBM versus, like, how did that distinguish from, say, the crypto ecosystem? Did you find yourself kind of distinct and siloed away, or did you find yourself connecting in with that ecosystem, or what did it look like being embedded there at IBM?
So I was really focused on enterprise blockchain networks, and I was part of most of the failed enterprise blockchain networks. So I have lots of lessons learned and interesting things about why those failed, which we can talk to if you're interested. Actually, the one I spend my most time on is actually still functioning. So I guess that's my one claim to fame. But it was very much on the enterprise side, and I'm very focused on the tech side of crypto still, because you need to have blockchains be better for use cases to get people transacting on chain and scale. And until that's the case, there's really no reason to build things on chain. So what I was really focused on is trying to figure out ways and use cases that large enterprises could come together. So I did one around supplier information management. We like 20 Fortune 500 countries trying to standardize that process. That was like the end of the account. There was like a supplier identity. Was involved in media and entertainment blockchain networks, about out provenance networks, a whole range of things. So it was kind of not degen at all. It was kind of like more buttoned up and focused on improving workflows and business processes. I think upon further reflection, you don't get as much automation, and there's not as much of ability to do that in private enterprise blockchain networks, which is why I've completely swung on the pendulum to public blockchain networks. But if you go back and listen to my podcast from 2019, I would say very different things today than I said on that podcast.
Interesting. Okay. Well, so and then maybe philosophically then, what would you say have been your biggest changes or maybe learnings or adaptations since 2019, or since coming out from IBM and into maybe crypto more generally versus just...
Well, there's lots of adaptations. So we can talk about this from lots of anthropological perspectives, but I would say, we can talk about the technology, but also just talk about some other things. So it's a different economic model. You can get very wealthy without actually building a product that delivers functionality or revenue. So and then the world operates kind of by its own rules. So crypto venture is very different than traditional venture in terms of how you think about getting a project funded. The things that matter in terms of project success, very different from Web2 SaaS companies.
Yeah.
So I would say that my my primary learnings were just that you have to kind of accept the rules of the insane asylum and play by those rules, because there are a bunch of rules that just don't make sense to outsiders. So I would say on the kind of like getting stuff done aspect, just a very different way of getting stuff done than Web3, even from something as simple as like using Telegram versus sending these massive emails with multiple paragraphs. So I think that I think the most interesting thing to me is just kind of like learning the rules. Because when I was on the outside in like 2018 and 2019, I was looking at people launching these crypto projects saying, how are they doing this? Like, what do they know that I don't know? How would you even think about putting one of these together? So I think that the learnings have been kind of like structural, that there is a well-defined blueprint, even if that blueprint might not make sense to outsiders. So I'd say that's the lesson learned. And that's what a lot of people coming into the space from Web2 have to either accept or not accept. There's rules, some of the rules don't make any sense, but they're still the rules. So I'd say
it's amazing how difficult that is to actually to come to terms with for someone like for me who is came in from Web 2 to Web 3 a little earlier than you did, but still I still find that difficult. Like I've got to grind those gears to go, oh yeah, this is Web 3. This is very different to even counterintuitive perhaps to how things seem to work in what you might call the real world, although perhaps Web 3 is becoming more real world now. But yeah, that is very interesting that you did.
It's crazy stuff. Like, going helping projects raise in like 2022, they'd be like, oh, I've got all this revenue. I say, don't talk about your revenue and any like Web3 investors. Don't even talk about it. Or, I think also it's interesting. We're kind of getting to like project creation value accrual. Like a big lesson is you can't accrue value to both equity and tokens. So as a founder, you have to make a decision at some point. Am I building a revenue-based business, or I'm trying to have value accrue to the token? So I think that, some stuff may be intuitive to people, in the industry, but it's certainly not intuitive for people trying to enter and understand it. And, it's not necessarily a bad thing that you don't have to generate revenue. You can still accrue value if you use your treasury well.
Sure.
But people don't know how to use their treasury. So that's another problem.
Oh man. All right. Well, so let's talk about what are you currently working on then? What's your newest project? Maybe how would you describe W3.io? What's the elevator pitch for that? Or what's a one sentence kind of overview? And then
W3.io is Swift for decentralized compute. So just like traditional clouds have an orchestration layer that you can use to combine different IT assets around an application, W3.io provides the equivalent functionality for the off-chain compute stack in Web3 that's aimed at making smart contracts better. So I think that what attracted me to Chainlink is I thought it could be that bridge between the off-chain world and the on-chain world.
Yeah. And
I still think that they have an important role to play in that, but I think the only way that you can bring workloads on-chain at scale is by doing two things. The first is smart contracts have to become a lot better. So if you look at what Chainlink did, one type of verifiable computation, that was price and data feeds, enabled DeFi. So what would be the possibilities if you could put 10 different types of verifiable computations that were interoperable into a smart contract and orchestrate workflows around those? Probably some stuff that we haven't thought about. But if you're talking about, starting at the beginning of our conversation, this needs to be a better technological layer if people are going to transact on it. And in order for it to be a better transactional layer, you have to get more functionality out of your smart contracts and better automation and the ability to do more trustless business processes. But what the primary issue was at IBM, these enterprise blockchain networks, is all you could really do on a private chain is audit and settle. And everyone then, because of that, had to basically calibrate their business processes one-to-one to participate in an enterprise blockchain network. Now, it's never going to happen with large companies, right? It's hard enough to get two companies to calibrate their business processes, much less 10, 15, 20, 25. So there was no blockchain middleware. So that's all the private enterprise blockchain networks could do. They could audit and they could settle. And that does not represent a better transactional layer. So our thesis here is that it's the money side of crypto provides you the ability to bootstrap network effects. And if you spend your treasury responsibly, to grow faster than you otherwise could. But in terms of the middleware stack and people who are building, the only way that you're going to get people coming in massive degrees of scale and architecting businesses processes on chain is if it's a better technological layer. So the money can help, but it has to start with the tech.
Yeah, man. Well, so if DeFi then is the proof of this concept, this new kind of vertical industry kind of pops up, are there other kinds of ones that you already foresee or that you're using or building in terms of proving this to be true across other verticals? What did that look like? Or what areas you look at?
So I think that it's interesting in this cycle because there's probably 4 areas of product market fit in the last one, which are DeFi, gaming, and NFTs. I think those are actually the only areas of product market fit at a big degree of scale. There hasn't been as many clear-cut areas of product market fit that have begun to emerge in this cycle yet. I think RWAs is an interesting one, although I think that there's a long way to go. So I think that the way that we'll know that we've gotten there is probably not net new things happening. It's probably the fact that we can do better things with more functionality on chain than we can do off chain.
Gotcha.
So can you use I think about this example, a lot of RWA examples out there where these big ambitions and everyone wants to do these great things. They're not possible. If you're thinking about something like cross-chain RWAs, in order to make that better than doing it off-chain, you have to have off-chain compute resources that can combine around identity, around security, around on-chain data, around off-chain data. Of course, you have to do the messaging layer itself. You probably want AI if you're going to do automatic portfolio rebalancing. So multi-party transactions should be more efficient on-chain than off-chain, but only if we can get more out of our smart contracts. So I think the first step here is work with people within the industry to get better smart contracts and more functionality in the applications that they're building. And at the same time, show people outside of the industry that smart contracts as a form of conditional logic is superior than the alternatives by demonstrating process efficiencies. As I said, people will not migrate to a technological layer unless it's substantially better because there are big switching costs. So the question is if we're going to increase the total addressable market for the industry as a whole, what are the steps that are required to do that? And at this juncture, although there's lots of great infrastructure being built, that incremental addition of additional infrastructure is not going to get us there, in my opinion.
Gotcha. So can you speak to then to the need for an integrated middleware of Web3? What is currently missing in the smart contract architecture in Ethereum or EVM, for example?
So Ethereum was kind of like programmable smart contracts, right? So you could program business logic in a pretty rudimentary way. So that was kind of programmable smart contracts. Right now we have what I kind of think of as instrumented smart contracts. So you can take a off-chain compute resource, a price or data feed, or decentralized data warehouse, or an AI agent, and you can use that to inform a smart contract or the conditional logic in a smart contract. Now, what W3 is going to provide is orchestrated smart contracts. And the way to think about that is right now I like Game of Thrones. There's lots of Game of Thrones fans listening to this podcast. So I think about like the Watchers on the Wall, in the North. So right now we have one off-chain compute resource basically looking at a smart contract and triggering based upon that output. What if we had 10 different off-chain compute primitives watching the same contract consistently? We could then orchestrate workflows around the change in a price and data feed, not just tell the smart contract as the price and data feed had changed. So that's the fundamental difference is that makes trustless business interactions possible. And then that makes things substantively better operating on-chain than the alternative. So that's why you need an orchestrated stack. Every tech stack has an orchestration layer. It's kind of more important in Web3 than otherwise because you have all these trust assumptions you have to make. So automation has to happen on the basis of trust, and it has to happen on the basis of better performance. And the only way you can do that is basically by allowing off-chain compute projects in the middleware stack to speak to each other. Because one thing I did learn in IBM, I learned some things that were probably not helpful here, but one thing I did learn that was helpful was people don't buy individual piece parts of a technology. They want a technological outcome. And the only way you can get a technological outcome on chain is by having the equivalent of off-chain precompiles. So we have on-chain precompiles. We need ways to combine functionality out of the box around things like real-world asset, blockchain-based gaming, reputation as a service. You can architect all sorts of cool stuff to happen around smart contracts if there's a framework for allowing different off-chain compute projects to speak to each other.
So would you say this is then, are we talking it's more like recreating the Web 2 tech stack on Web 3, or is this building something new that only Web 3 can do?
So the difference between some parts of the decentralized middleware stack and centralized alternatives is that the decentralized middleware stack is tailored and built to interact with smart contracts. So you can't get the same type of horsepower if you go to, a centralized alternative. And the decentralization and the trust minimization is what leads to process efficiencies. This is why the holy grail has been everyone conducting multi-party transactions on chain, because you decrease the need for an intermediary. Now, you can only really increase the need for an intermediary on complex processes if you have lots of different processes that can run in an interoperable way in a trustless fashion. That's where you get the efficiencies from. So basically, you can't do that right now, which makes operating on chain not as interesting as operating off chain. So the reason why decentralization is important, in this case, is not philosophical. It's quite pragmatic on a couple of levels. One is that if you have these trust assumptions, then you can much more easily run these multi-party business processes. And second of all, I think just from a broader adoption standpoint, there is going to be a time when the decentralized tech stack, just as a tech stack, not even focused on smart contracts, can compete with centralized alternatives. So those are the two reasons for being for W3. It's to make smart contracts better and to help the decentralized tech stack become competitive with the centralized tech stack, because the price that an IT service should be delivered in the future is going to be the marginal profit margin at which a decentralized network is willing to provide it.
Gotcha. So is there a timeline? Like, how long do you think that's going to be? Is it just a factor of it's already here? We just have to build it, or we have to actually find a way to get there? What's the kind of roadmap from here to there?
I think that making smart contracts better is a shorter time horizon. So I think that can happen in a couple of years. Having decentralized tech compete head to head with centralized tech, there's a number of things that need to be solved. First is the problem we're solving, which is how do you, if you think about Amazon or Azure or GCP, 70-80% of the revenue is base layer compute. So when you see people investing in these decentralized GPU and CPU networks, it's a good bet over time, but only if there's workloads that can run on top of them. And those are most likely going to be decentralized workloads. So there's some stack integration that has to happen. There also has to be kind of like proving the model. So if you look at low levels of performance, decentralized GPUs perform favorably against centralized alternatives. Projects like Fleek with edge functions compete with centralized CDNs. Same thing with space and time and data warehousing. So these things can compete at low levels, with low levels of usage and consumption favorably on performance and cost. So the model needs to be proved out that this can happen at scale. But there also has to be a front door to the decentralized tech stack, which includes things like SLAs, which includes a user interface where people can very easily provision, includes ways for workloads to be moved over. Cost is not enough. You got to create outcomes. But there are projects like Filecoin and Arweave, which on the storage things are competitive, from a cost and functionality perspective. But the question is how do you make this stuff easily accessible to the end user and convince people to actually, this is a better tech stack in its own right, decentralization aside. And I think that would certainly take some time, but there are going to be certain processes that you can begin to carve out slowly if you can put this in a format that people can actually consume, given the constraints that people working in larger companies actually face in relation to purchasing IT services.
Sure, because there's that threshold of incumbency as well, where it has to be significantly better for a large organization to want to get off even an old system. So many. It seems like sometimes the bigger the company, the older their systems, because it's just so costly and just prohibitive. There's no will in the organization to actually change how they do it. So it's got to be significantly better across the whole ecosystem, really. And so what you're saying is we might be there philosophically now, and perhaps even technologically, but in terms of building that out so it's usable. And at the end of the day, some people will not care if it's decentralized or if it's built on, blockchain or Web3, so long as it does what they need it to do better than their current thing. What do you think that, beyond getting, world-class salespeople in to try to convince people over, how do you make something so composable, so usable, so much better, and demonstrate that value, not just the key decision makers, but the people who will be actually implementing and utilizing those things? This seems like a massive mountain to climb. How are you tackling that mountain? Is it just build it and they will come, or onboard slowly, or develop strong partnerships? How are you thinking about this?
So first of all, it has to be done on an industry-wide basis. So we're already working with most of the top projects in the middleware stack. They're network partners on the supply side. And the reason why they joined is because they see that what I see is that if you're better, stronger together, the TAM goes up if you work together. The second part of the process we're working on right now is getting participation from the major L1s and L2s. And this is not simply, do a co-marketing announcement. It's come sit on a governance board, figure out what the standard should be, figure out how to integrate the decentralized tech stack into the normal rhythms of how your ecosystem is operating. So it's kind of like organizationally and structurally, it almost has to be kind of like an enterprise blockchain network, which is there's not very many comps in our industry. So there'll be opportunity for community members to participate in governance as well. But in many respects, this is a pie expanding exercise for everybody. And if we take the mindset as an industry that will be stronger working together to establish these standards because it provides an on-ramp for enhanced usage, that can roll the ball forward. And if you have a widespread industry consensus, you have more credibility with anybody. So a third network convening phase might be having Web2 companies, participate in governance or, provide some type of input into the network. So the hill is hard to climb partially because we have to reframe the debate and make this less about the monetization and the meme coins, which I like, man, have fun, great.
Sure.
I love the crypto community. But if you think about making this a mainstream layer for multi-party transactions, which is where blockchains have their competitive advantage. It's not if you don't need to have trust with other parties as if you do, which is a large volume of transactions. I couldn't quantify how many, the overall IT transactions are of that nature. But it's going to be a better transactional layer for doing that. And we have to kind of take a page out of the playbook from Web2 tech. And that's when you delivering POCs, you're quantitatively showing this, here's how it makes smart contracts better. And here's how it's just a better IT stack. And you have to work in the confines of, providing relevance and legitimacy to this. I think that the way that, companies like Circle and Coinbase have done it around stablecoins is a very good blueprint on the money side for how companies on the tech side can begin to make that similar types of arguments, that there are benefits to doing it a different way, and it's possible to do it a bit different way, and it's actually desirable to do things in a different type of way. So that's why we kind of like this, we call it the power of we. We have W3.io, we also have we.io. Because there's lots of things that need to happen for the promise of decentralization to be realized, and it cannot happen unless there's a better tech stack.
Alrighty, so I know I've spoken to this a little bit already, but how do you build a better integrated tech stack? What does that actually materially look like?
So the way that you have to do it around decentralized protocols is you basically have to accept the trust assumptions for each decentralized protocol. So if you get into a situation where you're trying to combine trust assumptions, this becomes a nightmare. So the way you do it in practice is you're looking for the output of kind of like a data handshake between one to however many decentralized protocols. So you're validating that the combination of computations from decentralized protocols is accurate. You do that basically setting up a series of state machines. And then what the network does is it validates that combination of outputs is accurate. It orders the commands and it sends all those commands into a smart contract all at once. So the way you integrate is basically through trust assumptions. And you can use things, if you want more security, you can use things like EigenLayer, they're a partner on the network. So there are ways that you can kind of integrate what you'd like about crypto and some of the things that are typically a hindrance to decentralized networks to make this thing work. So lots of the pieces are kind of like coming together. And the way that we view this is kind of like a channel protocol almost. You can plug it into a roll-up as a service provider, can plug it into their infrastructure because their infrastructure is a service, or if it's an abstraction layer like the AvaCloud, this just plugs in right behind. The end user may know it's working, may not know it's running. We don't care. Our job is to increase the TAM for on-chain activity and also for the middleware stack.
All right. I want to pick up on something that you just said earlier. You said you mentioned Base and Circle on the money side versus us on the tech side. How do you think about it in terms of Web3 or blockchain as an ecosystem or crypto maybe generally? How are you thinking about it in terms of the money side and the tech side? And obviously they need to do they need each other? The money side needs the tech side. I'm assuming that the tech side needs the money side, or it is money at least in some capacity.
Correct.
How are you thinking about why do you draw a distinction there, or how do you think about those two areas, I guess, working together or not?
I mean, so when I talk about the money side of crypto, there's two ways of thinking about it. One of these is like people's fascination with price appreciation and talking about what Bitcoin will be worth or Ethereum will be worth. And this happens on lots of podcasts. And I don't think that this is not I mean, it's interesting to me to the extent I hold some. This is not interesting topics if you want people doing more things on chain. There's another money side to this, which is innovation. So stable coins, very interesting. I think it's going to lead to lots of cool stuff. Restaking also probably leads to some cool stuff in yield generation. DeFi and the Bitcoin ecosystem, which is the biggest source of value. There's too many Bitcoin L2s, but it's interesting. It's a big source of value, and there needs to be a DeFi ecosystem there. So I think that manufacturing yield is definitely one thing that the industry is focused on, and I'm cool with that. I think that's important. So it can be a better financial system in many types of ways, but that's limited to kind of like one activity, right? Without the tech, you can't run the processes more efficient. You can certainly generate the yield, which people are already doing, but why is it better to have all assets live on chain? How does that create more financial instruments and opportunities? That can't happen unless you get more out of your smart contracts and when you have an integrated stack to process all this stuff. Mm-hmm. So I think that the money side of crypto is kind of like led the way, especially in some of the areas where I think product market fit has been achieved. So maybe I'm actually not, maybe I've got to withdraw on one of my other statements, like stable coins definitely have product market fit. RWAs are kind of getting there. So there are more areas of product market fit this cycle that have emerged. But I think that the end game here is like what Larry Fink from BlackRock said, everything's tokenized. For everything to be tokenized, you're going to have way better technology to manage everything and generate the business process efficiencies, because just issuing is not that interesting because it doesn't touch upon the way that people transact with one another.
Well, yeah. What about when like central bank digital coins and governments start moving things on chain? We're going to need much more robust tech stack and interactions than we currently do now. Otherwise, it's going to remain very, very simple. And I don't know, maybe people will just default back to a centralized system because it's cumbersome or costly or can't control it or any of those kinds of things. And so, yeah, man, I think this is a very important thing. I've been hearing whispers of W3 for a little while, always in kind of hushed tones in secret rooms and whatnot. Why are you talking about? Has that been deliberate, or you just been head down building the thing? Why talk about it more now?
We're in stealth, but so there'll be more information released and kind of like more to come. But I think it's because we're trying to build like an industry consensus, and that takes a lot of time. Yep. And also because it's very exciting for an idea you've been working on for a number of years to kind of start seeing the light of day, and you can kind of say, oh, I was thinking about all these things. It's gratifying to see it happening. So, I think that we will start talking about it more, but we're happy to start talking about it a little bit right now.
That's great, man. What have been some of the reactions? So you mentioned Eigenlayer, for example, as you're going around talking to different protocols and L1s, L2s, different, many of the larger players who have, a significant stake in the future of Web3. How are you finding the response to like people understanding it immediately, going, yes, this is what we've been waiting for? And we're saying, oh, that's a big mountain to climb. How are you finding the response so far?
It's been very positive because I do think people understand that there are substantial constraints in terms of allowing people to do things on chain and making it better. So the L1 and L2 ecosystems, they want more developers, they want more activity, they want people to be building more things. The supply side of the equation, which is the middleware stack, I think that these are all tech people, so they understand pretty intrinsically that in order for their business to grow, there needs to be this connectivity with other adjacent things that they need to go serve more, good things to the end user. So I think that it's been very positive on the L1 and L2 on the supply side. I think that it's interesting going through the raise. I think that some investors had a hard time getting their head around it just because it's very different, right? And the interesting thing about this business is that it's kind of 50% technologically, but it's 50% organizational because you have to find ways of getting parties around the table to do things that they haven't done previously. Yeah. And I think that's the benefit of the approach, and also where it provides lots of defensibility, because if we do our job right and we serve as an entity that's viewed and practices increasing the size of the pie, then there's really no reason for there to be two of these. If you look at kind of Swift or the DTCC around derivatives, There's only one of them because they serve as an industry utility. So I think that's what's counterintuitive here. Typically, the motions in our industry are go raise money, build stuff, and then engage with people. To put enterprise blockchain networks together, the methodology is actually backwards. It's go organize everybody, talk to them, and then work together to build something that everybody wants. So I think it's the response has been good. I think it's just a very different way of thinking about how to expand the pie, and the role the different organizations who are competitors can play in collaborating to increase overall goods for everybody.
Yeah, man. If you're happy to talk about it, how did you do that? Like, what credibility is it? Because you had been with Chainlink and for the IBM, and so you came and said, "Hey, we're building something awesome. You can trust me." Like, rather than just a trust me, bro. How do you go about collecting those? Because surely there are some, maybe once you get 3 or 4 or a critical mass, then people go, "Oh, everybody's doing it," and then it's perhaps easier or simpler. Maybe not easier, but simpler from there. But how do you go getting those first 3 or 4? Is it just knocking on doors? Is it a prior relationships that you've been talking about it in, on calls, whatever, going, "Oh man, what we're missing is this kind of whole middleware section. Maybe someone should do that. Do something about that someday," and go back to it and say, "Hey, we're doing something about it." How does it actually happen?
So interesting question. Yeah. So when I came into Chainlink, I had 0 Web3 native networks. So I basically had to learn all the rules we talked about by doing them. And doing meant like 50 hours of Zoom call a week in 30-minute increments, for probably 10 or 11 months. So I think that one of our team's overall philosophies is to give first to people without the expectation of getting something in return. So if anyone's read Adam Grant's book, Give and Take, you should read it, even if it's the Cliff Notes. But the basic premise there is that people who give first can be exploited by people who are going to take advantage of it, but they ultimately come out ahead because they play for the love of the game, not to necessarily win in any individual interaction. So after I left Chainlink, a lot of the projects that I invested in while I was there, started advising them, but just being generally helpful to people, getting on, I developed a pretty extensive network, kind of getting on calls, like helping people think through their fundraising or talk about, just philosophize on the future of compute. So I think it's a combination of, you have to, we were fortunate to come out of the gate with some strong relationships. Sales 1 through 3, as you said, are always the hardest. 3 through 5, a little bit harder. 5 through 10, once you start collecting lots of consensus, then it becomes quite easy. So I think the way you have to do that is you have to know what you're talking about. So you have to have credibility in terms of your ability to bring something like this together. So in my case, it was working at Chainlink, where I invested in 25 companies largely in this part of the stack, being super helpful to them. And then number 2, the background from IBM, knowing how to put these kind of like networks together. Mm-hmm. So we started convening the supply side in East Denver of 2023, actually. And then we only started going out for funding kind of like in the beginning of 2024. So there's a process of kind of like figuring out, how will this work? And we found, we started, incubated this a bit. We found amazing co-founders. So that was a really important part of the equation. But I feel like in our space especially, people appreciate people who are genuine and who treat others with a lot of respect and kind of give first as a default. So if you do that as a general principle, sometimes people won't appreciate it or they don't reciprocate, which is actually the point. It's to select in people who you want to work with and who see your vision of the world and want to collaborate and have fun and make their business better and do cool things. So it's been kind of cool seeing the community come together, and the people operating the middleware stack are generally a really interesting group of people who balance the need between wanting to build really fundamental tech that matters, and also whatever crypto CEO has to deal with is how am I going to manage my community and have my token be worth something. So the process, it's just counterintuitive, I think. Unless you've gone through convening an enterprise blockchain network, it's counterintuitive to do it this way versus the way the crypto projects typically launch.
Yes, gotcha. Man, it's unsurprising to me how many people I've had on this podcast who are successful, even serial successful founders who subscribe to the Give First, and yet how rare it is actually out in kind of mainstream world, Web3 or otherwise. But yeah, man, I 100% subscribe to that same philosophy. Absolutely. We have a lot of founders who listen or watch this podcast. As a founder yourself, what would what are some of the more difficult parts of being a founder? And do you have any advice for founders, in particular, looking at that scaling or go-to-market, kind of last mile to launch? Can you speak to that?
So it's interesting. We run like a mid-stage founders network. So founders who raise around $10 million, maybe a bit more. And we had an event at ETH Denver, and we had like a whole list of topics. We had like 40 CEOs in the room, and we got through one question. And the one question was, as I mentioned before, how do you balance the need to build something fundamental that's going to change the world in a positive way and do the things that great entrepreneurs want to, with the game that you have to play in Web3 to, build a community and have a token that's worth something to give yourself the treasury and the firepower to do things. So I think that there's a couple of things. Like, one, be realistic with yourself. So if you don't want to play the Web3 game, this probably is not the business for you. A token-based community is probably not the business for you. Absolutely. I think also just the other important thing is think about where the value is going to accrue. As I said before, it's basically impossible to have the value accrue to both the equity of the token, and you make very different decisions based upon where that value is going to accrue. So start out of the gate understanding where you think the value is going to accrue in your company. I think in terms of like a go-to-market, understanding that there's kind of 3 different reasons why you want to talk with a potential partner or customer. So one is obviously to get real usage. One is to build community and do co-marketing, so which is just announcement based. And the third reason is to work on something strategic or longer term. But there's not you have to understand the right balance here. If you're having value accrue to the token, there's good co-marketing announcements are very helpful, and you don't have to focus as much on generating revenue, because that's not what the retail market or the VC market is going to reward you for. So I think it's kind of just being, good crypto founders. I think sometimes it takes people a little while longer to learn than others. In our advisory business, we work with a lot of Web2 to Web3 founders, so we kind of see this pretty frequently. But it's just kind of being deliberative in terms of the type of project you want to build. So, if you want in a bull market cycle, if you have more favorable vesting terms, you can raise money easier. Mm-hmm. But then there's drawbacks in terms of long-term project sustainability. So, what are you trying to optimize for? And look in the mirror and really think about whether the problem you're working on is the one you want to be waking up thinking about every day, and whether the thing that you're building is actually what you want to be spending your time on. Just, in terms of the overall end game.
So are there templates, or are there kind of game theory strategies that you keep coming back to, or is every project truly different? Or is it there's one true path with a couple of nuances, or a standard deviation of difference in terms of your strategy? How are you finding that when it comes to projects launching, especially the ones that you're advising, for example?
So I think that there's a couple of things that are fundamental to understand. So the first is that spending more money on things that are not going to get you to the next round is not money well spent. So understand what you have to deliver and what you don't have to deliver to get to the next funding round, which allows you to scale up. So lots of teams want to go very heavy on the tech when investors might be okay with the much lighter tech, or they start marketing way too early when that's not going to help get to the next round. So the biggest risk that any project that raises amount of money that's reasonable is, in terms of people and investors coming out ahead in the deal, the team of the investors, is running out of cash. And you saw tons of projects do this in the last cycle. It does not help. So that's a super important lesson, is it does not help to overspend. It just doesn't, because you don't have to buy revenue. You don't need to show revenue growth in the same metrics that require spending lots of money to go raise your next round. So I think that that's one really important lesson that I probably came to only after going through the W3 process and thinking about it really deeply. But I think that's a really important lesson for founders. So there is a template in terms of how the game works in terms of getting from round to round. And I think that people have to be cognizant of, especially with their balance sheet, about what that game involves. And it's pretty simple, right? You got to come up with you got to have some level of adoption with a tech that works somewhat hitched to a narrative that people are going to like. I mean, that's the templatized version of what I think is on this one. In terms of a successful launch, I think that there is a templatized version for this, because we have 5 or 6 projects who are going through the same exact process right now. So what's interesting about that is that your head of marketing becomes the CEO effectively. not on the product side, but in terms of telling people what's needed when it's needed. And you don't want to start that process too early. You want to start, work back 6 months, and then the head of marketing needs to say, okay, this is what we need, the growth in our socials, go to market lead. You got to send me, 10 just marketing announcements. I need 3 real customers showing this type of an outcome. So I think that there's a well-defined process for how to launch successfully. There's how much your token is going to be worth on day one is a lot of different factors. It comes down to the community, it comes down to the hype, it comes down to what exchanges you're on, it comes down to how much liquidity you can get on, and maintain on the token, which comes down to how good your story is. So I feel like it isn't much, if you understand the rules of the matrix here, it's much easier to get to a positive economic outcome because the path to that economic outcome is pretty well defined.
Yeah. Okay. I mean, that's good advice. I mean, that's kind of a giant headline with, 20,000 words of copy underneath. But yeah, that's very good. Does that impact, because I know you said before, you also do advisory and investing, and you got Helix there. What kind of drives your thesis, or how are you thinking about either the market now or the kinds of projects or teams or verticals even that you are keen to invest in or advise, spend your money and your effort and your expertise on? What does that look like?
So we're
personally, I mean, and then also Helix.
Yeah. So we're 3 trick ponies at Helix. So we do off-chain compute, we do vertical marketplaces, which is both compute and not compute related deepen. So it doesn't have to be physical. It can just be some underlying thing that powers like some asset. It could be a car, it could be DNA profiles, it could be social profiles that allows for composability on top. Mm-hmm. And then we do ecosystem development. So we underwrite on the advisory side very similarly to how a VC underwrites. So we have a thesis on categories that we want exposure into that kind of fit with our overall idea of how the industry is evolving. And we only talk with people who like thinking about the stuff we like thinking about. So those are the only, I don't know anything about DeFi. I guess I do. I was surprised actually it was in the session. I know more than I thought I did, but it's not like a major area of focus. But I think that in terms of like founders, like for us, if someone's not responding in 24 hours maximum to us, we won't do it. If there's anything that just feels off, because we typically work for projects with years, we're kind of more like fractional founders than we are traditional advisors. There's a fund who I know was talking to another fund that was the lead for a project we work on, and they said, David joined the management team of this other project because he's doing all this stuff. And I said, no, we actually do stuff. And they said, my other friend said, stop doing this. You're setting the bar too high. So it's kind of like, you have to have, the idea has to be good enough and it has to be the upside. But it comes down to really people. I mean, our founders are kind of like on average, like mid-30s. That's probably the average age. Mm-hmm. So we skew upwards and we look for people who have built and sold companies, who take direct feedback really well, who move extremely quickly, who do things without having to, do things autonomously, like really good founders who get shit done. So that's kind of the most important thing. And of course, you got to enjoy spending time with the person. So I think that you got to trust your gut when you're getting into these types of long-term things. Even if you can make a lot of money potentially, if there's something that feels off, you just got to walk. And that's been a big lesson learned, is that it's fun. This was interesting. I used to work in IBM Cities business. When smart cities was in vogue, and basically fundamental change happened by people sitting in a room and just deciding to do things differently. And I think that's how a lot of interesting things happening in life. It's just finding the right people in the right circumstances in the right situation, and becoming good friends and involved in each other's lives and making some money along the way and learning stuff and having a good time. So I think that the advisory business is tough when it's tough anyways, but when people are generalists, I think it's really tough to do. If you don't have a partner, it's very tough to do because you have to spend a lot of your time maintaining a network. You have to spend time finding new projects. You have to spend time working with existing projects. But if you can make it work, it's analogous to like, I officiate some weddings for my friends sometimes. And it's like a very intimate moment. You're up with someone when they're getting married and you're doing the vows and stuff. It's a different type of intimacy, but having that with people who are building really great projects or just happen to be awesome people is like a very special thing to be a part of, I think.
Yeah, that's awesome, man. It's a great perspective too. I also officiate some weddings.
Oh yeah?
And also yesterday was talking with some founders and they were asking about, again, investment thesis, or what does it take? And the tech that they're building looks really great team, strong background. And like you just said, I'm like, what's really going to sell it for us, especially in this kind of, in this market where money is flying fairly fast, things are building very quickly. Like I said, it comes down to the team. Do you want to actually spend hours on a call with this person? Are you invested in their success? Are you invested in their life? Like, do you care? And if the person is, like I say, responding to messages, teachable, a great operator, works independently, like actually can go and take advice and make it happen without you having to drag them across the line, which is the bane of an advisor's existence. It's just wonderful actually to work with those kinds of people. And it might not even be that particular project. It might be, that sort of okay project, but the next thing or what that leads to might be awesome. And working with that team, it's the team that's actually, and
it's great if you're in this space where you're having those types of interactions with people who you're not formally have no commercial relationship with,
totally,
or you're not formally working with. So going back to what we said before, if you have a mentality to kind of like give first and just, I think the things that excite me are meeting interesting people, learning things, and making money, probably in that order. If you can make more money, it's obviously better than less. But if you just kind of have that mentality where you're, as I said, you're not playing to win, you're just playing to play with people you think are interesting and being helpful to them. And you can make lots of friends, and sometimes those result in commercial relationships. And sometimes you just got a friend who you go, drink a lot of beer with and stay out till 4 a.m. I think that's like in terms of like, you never know how people in your life are going to come back around, or, what's going to happen with relationships you have. So the best thing to do is just find people you like and you learn from and keep talking with them.
Yeah, man, that's cool. We don't have much time left, but I do want to, you mentioned fractional founders before. I wonder if you could expand on what that is for someone who hasn't heard that phrase before.
So it's basically, so on our advisory portfolio, we don't take any cash compensation. So our incentives are completely aligned with the founders that we work with. But the way things are structured is, unless we do something really bad, this is important. We can be dismissed, but we get to keep our economics. So we're typically an outside party that can actually act as part of the team in ways that most team members can, especially with CEOs, because we can say whatever we're actually thinking at any given time. We're respectful, of course, but you have to be on equal footing, especially with the leadership teams that you work with, because a lot of what a good advisor does is kind of like be annoying and like make you focus on things you don't want to. And psychologically speaking, the easiest way people don't like that. So if you don't have a very open-ended relationship, it's in people's incentive to get rid of that annoying psychological trigger.
Gotcha.
If they can. I think that the other thing is that the scopes we have are extremely open-ended. There's not any deliverables that we're committing to actually do, which is a good thing if you have people who actually like to get shit done and work autonomously. It's bad if you hire advisors who don't like to do anything. Yeah. But we've done things like, run the sales team for 3 or 4 months, negotiate big corporate development deals, obviously help on the fundraising, on the product. If there's a legal issue, sometimes we'll get it and just work with the lawyers and the team on it. So if you have like a very long time horizon and you're a good advisor, you're looking for ways to add value all the time. But most advisory relationships are just get on it. It's not be part of the team. It's get on a call from time to time. I think there's value in that as well. But if you embed in the team, it's like, we find it's most rewarding, like both emotionally and personally, and quite frankly financially, because you can work on lots of different and interesting things. It's kind of like being a venture capitalist who puts their time in. But it's always fun if you're working with the right people and you have the interest and ability of being proactive and not waiting for someone to give you things to do. It's coming to the table saying, we could be doing this, we could be doing that. So that's what it means. It's like, it's basically being part of the team. And I think that's when the projects that we work with, that's how we're viewed.
Yeah, man, that's great. How do you find balancing that with building W3 and, obviously
not a lot of sleep.
Yeah. Some of them will obviously be a really good fit for W3 as well. Yeah. So, you keep it to those vocals. But yeah.
Running a company and doing advisory at the same time is challenging. It certainly is. I think that a lot of the hard work here is actually establishing like the connections and the understanding of things. So then work with advisory companies. So if you had to be learning all of that stuff, well, also like I run all the ecosystem for W3. That's my, in terms of our core contributors, that's my role. I think that you have to do both very well, and that requires a lot of time. And you have to. It's just about finding the right balance. But I think it's also, you have a big advantage because you do, like you talked about initial partners. Like, a lot of those initial partners are folks we've known for a very long time.
Yeah,
some of them on the advisory basis.
Yeah, gotcha. All right.
But being an operator it's given me a lot more empathy for people we work with, being on the operator side now, in a whole range of ways. So I think, I've done operator experience before, just not like a 0 to 1 crypto startup. It does make you a better advisor for sure.
Do you have advisors now advising you?
I do. This is what's interesting about it. Yeah, exactly. Of course. And it's funny to be on the other side of the trade because everybody needs other people to basically be telling them things they need to get better on. So it was very interesting. Like even during the raise, we had some advisors who were making introductions, and I'm like, "Oh, this is kind of weird. This is like what I always do for people." And then you call it out for strategy. So like, I think that anybody who's in, like, if you're in something so deeply, working on it all the time, like I think that's the benefit of good advisors, is they're on the outside. And if you have that level of trust, then they can help you see things and focus on things that you either can't see or you don't want to see. And that's why you want to surround yourself with people who are very direct and who are willing to challenge you, because that's how you get better. And that's what the best entrepreneurs want anyways. I've met good entrepreneurs who are like, don't challenge me or try to tell me something to do something in a better way. They might say, shut the hell up, David. I already made my decision. Don't talk to me about it anymore, which, okay, that's fine. But, that's people's prerogative. But I think that being open to have that dialogue is super important.
Yeah, man. Hey, there are lots of threads I'd like to pull on. We've always spoken about it already. But I've got one more question, and I always like to ask, what would you say is your most contrarian view? Thing that most other people seem to think we're going one way, but you think we're going another way, or people think is very important, you think is not very important, or things that people think is going to be great, you think it's going to be terrible, or vice versa. Do you have any particular contrarian views you might benefit from?
I mean, I think it's what we talked about before. I'm not sure if you consider that to be contrarian. I think the contrarian view is the economic side of this is not nearly as interesting as the technological side. And the companies that are going to basically be the $1 trillion protocols as opposed to the $1 billion protocols are going to likely emerge on the tech side of crypto, just like they have in traditional Web 2 world, where big time tech companies are worth way more than the banks they service. So there's been investments in infrastructure, but I think lots of the retail attention and media attention is still on something that's not going to push the industry forward as much as focusing on the tech will.
Yeah, man. I totally agree. And it's also what
awesome.
I see. It's what you see. So when I came into, the Web3 world, although we didn't call it that back in 2017, that's what all the people from the 2014 cohort were saying. Some people from the 2012 cohort were saying. Some people from the 2008 cohort were saying. And certainly I found it true for the people who came in and, DeFi summer or 2022 or in this most recent bull. It seems to be the same thing, that the longer you're in, the more you see. It's the people who are actually building something useful that is not just let's get the pumponomics happening and make some cash, but let's build something that people actually want to use, makes their life better, is better than what they're currently using. They're the things that are actually going to not just make it, but actually make money as well.
I agree. I mean, and once again, it's making money is not bad. I'm not saying that. And if people want to, launch meme coins, that's great. I mean, that's a good way of making money, and it's fun. I think that I think people underestimate, or maybe they don't. I don't know, the number of like really thoughtful founders who are trying to do something big in this industry, and I think lots of them will. But there's just lots of noise. All
right, David. If people want to find out more about Helix, more about W3.io, or to hear more from you personally, where can they do that online?
LinkedIn is probably the best way. The W3 website is extremely minimalist right now, as is the Helix website, but by design on the Helix one. That's probably the best place to find me.
W3 still stealthy, right?
Yeah, it's still stealthy. Yeah, they'll be, it's, you'll see the logo on the website, and the Helix one, there's a couple quotes. That's about it.
All right. So LinkedIn. I'll put some
Yeah, that's probably the best place to find it. Yeah, exactly. It's probably not a place that people say most of the time, but that's the best place I can think of.
Okay. All righty. Well, thank you so much for joining us, man. Really looking forward to seeing how you go, like continue to build W3 and what that looks like, and kind of bringing a lot of the big players in the industry together to make something really awesome, actually. That'll, the whole rising tide lifting all the ships. I really think it's going to be one of those things, and really pumped that people like you are spearheading that endeavor. So thanks very much, and hope we can have you back on the show sometime in the future to hear more about it.
All right. Appreciate you. Thanks for having me.
Thank you for joining us again today. We hope you enjoyed this episode of Chain. We love bringing you great guests like David, and hope we've inspired you to learn more about Web3, about technology, even about how you might be a part of building that future. As always, like, subscribe, or even better yet, share this episode with a friend. Help us spread the word, and join us again next week for another great episode of the Off-Chain Podcast. Catch you then.